Welcome to today's deep dive. We're unpacking a really massive May 2026 macroeconomic strategy report today, because overnight, literally 20 million barrels of oil just vanished from the global market.
Yeah, it is, it's pretty wild to see the ripple effects happening in real time.
Totally. So the mission today is to decode exactly why a blockade thousands of miles away is suddenly cratering your tech stocks and making your grocery bill surge. Okay, let's unpack this. On March 4th, the Strait of Hormuz effectively closed due to the Middle East conflict.
Right, which is just a massive, unavoidable geopolitical reality.
Exactly. I mean, it's like pinching the global economy's main artery. There are no detours.
Yeah.
So Brent crude instantly shot up to like $111.34 a barrel. But here's what I really want to ask you. Is this just temporary market panic, or are we looking at a permanent structural reality for your portfolio?
What's fascinating here is while we aren't just dealing with fear or a sentiment-driven risk premium, this is a genuine physical math problem. You can't just reroute 20 million barrels of oil a day.
Because the alternative pipelines just don't have the capacity, right?
Exactly. They simply don't have the physical capacity. And you can see how this physical shortage is basically splitting the global economy in half right now.
Right, because the U.S. seems to be brushing it off, maintaining a pretty resilient 2% growth rate. But Europe looks like it's hitting a total brick wall.
Because of how their energy grids are built. I mean, the U.S. has this integrated domestic energy market, so we produce a lot of what we need. Europe, on the other hand, relies heavily on imports.
So they're incredibly vulnerable.
Highly vulnerable. When the strait closed, Europe instantly lost access to Qatari liquefied natural gas, or LNG. And they lost it right when their winter storage reserves were basically running on fumes.
Oh, wow. That is awful timing.
It really is.
Yeah.
That shock is pushing them straight into energy-induced stagflation. Prices are soaring, but economic growth has completely stalled out.
And it's not just Europe feeling the price pinch, right? Because that physical shortage transmits directly into sticky global inflation everywhere. I mean, U.S. gasoline is back at $4 a gallon.
Yeah, it's definitely hitting home.
But the stat that really blew my mind in this report was urea-based fertilizer jumping 60%. Wait, why is fertilizer spiking just because oil is blocked?
So this is the hidden domino effect. Natural gas isn't just used to, heat your home. It is the literal chemical feedstock used to create urea fertilizer.
Oh, I see.
Yeah, so when energy gets choked at the strait, it doesn't just impact your commute, it actually chokes the global food supply chain right at its source. And that's exactly why April's CPI came in stubbornly high at 3.8%.
So inflation is stuck, which means the Fed is trapped in this higher-for-longer interest rate regime. The report mentions the 10-year Treasury yield is up to 4.67%.
It's huge.
Yeah, and it advises trimming long-dated Treasuries because of yield curve steepening. Let's pause there for a second. Why does a 4.67% rate mean I need to drop my long-term bonds?
Well, think of it like a seesaw. When inflation expectations rise and the Fed keeps rates high, newly issued bonds pay a better return. So the older long-term bonds you're holding, the ones that pay a lower locked-in rate, they lose their value on the open market.
Got it. So investors demand a higher yield to lock their money away for 10 years.
Exactly. Especially in an inflationary world.
Okay, and that 4.67% yield is acting like gravity on the stock market. Tech momentum looks completely exhausted. Everyone is treating NVIDIA's May 20th earnings as this massive litmus test to see if tech can even survive this gravity.
Definitely. And meanwhile, boring defensive sectors are surging. I mean, energy is up 14%, consumer staples are up 9%.
Right, but here's where it gets really interesting. Are you seriously telling me investors are genuinely abandoning AI technology to go buy Costco and Chevron? Like, that feels like a massive overreaction to a temporary shipping problem.
If we connect this to the bigger picture, it's not an overreaction. It's really a survival tactic. We are operating in a late-stage economy dealing with extreme geopolitical friction.
So the rules have totally changed.
Completely. When money was cheap, astronomical AI valuations made sense. But when you can get a guaranteed 4.67% risk-free yield just for holding government debt, the believability of those massive tech valuations starts to crack.
So in this environment, boring cash flow is king.
Exactly. Boring, reliable cash flow isn't just a temporary safe room while the storm passes. It becomes an essential fortress.
Okay, so the defensive playbook is the real deal right now. The report suggests rotating into short-duration cash to take advantage of those higher rates, and then it pivots to precious metals. It says gold is trading around $4,552 an ounce, basically acting as a conditional hedge against all this systemic risk.
Yeah, and then there's silver, sitting at $84. This raises a really important question about dual identity assets.
Because silver is incredibly conflicted right now, right?
Exactly, yes. It's a monetary safe haven like gold, but it's also a critical industrial metal that's just getting eaten up by the production of solar panels and electronics.
So it's caught between being a financial shield and being squeezed by a structural supply deficit.
You nailed it, which makes silver a highly volatile bet compared to gold.
So what does this all mean for you, looking at your own accounts? It means the era of relying solely on tech growth to carry your portfolio is yielding to a focus on defense technology and critical minerals.
The baseline has fundamentally shifted. We've moved away from endless liquidity and stepped into an environment defined by hard physical constraints.
Which leaves us with a critical thought to end on. As these global supply chains fracture and rewrite themselves around conflict zones, will the era of global free trade ever actually return? Or is this fragmented, defense-first economy the permanent new reality for your portfolio?